You know it's hard out here for a bill. When they tryna get this money for a real. For the Cadillacs and gas money spent. Cause a whole lot of
Hey everyone, it's Mike Malarczyk at New Fed Mortgage. Man, I gotta tell you, there are just some days where I feel exactly like that song. It's hard out here, you know, whether you're a mortgage guy like me or a realtor or even a buyer or seller. It's not easy right now, and you guys are probably feeling the same way. So today I wanted to give a little insight about what I see happening, what's gone on the past couple weeks, and kind of give a thought as to where I see October going and through the rest of the year. Listen, I'm just going to give it to you straight. Right now, rates are FUBAR, with an emphasis on the FU. A couple weeks ago, the Feds raised interest rates again, 75 basis points. Now that does not directly impact mortgage rates, but what it does, it causes volatility in the markets, which in turn creates these wild fluctuations we've been seeing in mortgage interest rates pretty much on a daily basis over the past 10 days. I mean, they've just been crazy. I mean, that's all I can say. We are starting to make some recoveries, but I just wanted to talk about what I see happening this month and in the rest of the year. So what the Fed is trying to do here is they are desperate to get inflation under control, and are going to have to continue to put pressure on the financial markets by raising the federal fund rates in an effort to combat inflation. Okay, so the general assumption of most people I've been talking to is that the Fed is going to continue to raise rates when it meets in November and again in December. The anticipation here is they're going to increase this another 125 basis points by the end of the year. So that means likely when they meet in November, they're probably going to raise it an additional 75 basis points, and then probably another 50 basis points when they meet here in December. And as you can kind of see here in this slide, okay, going into 2023, they're projecting the federal funds rate at 4.6%, which is a touch higher than it is right now at 4.4%. And, not to be a Debbie Downer here, but if you look at unemployment rate, unemployment is expected to rise from 3.8% to 4.4% in 2023. And then the GDP, they were forecasting initially a 1.7% growth rate for this year, and they just readjusted that forecast to a projection of just 0.2%. So not great news. But as Bill Belichick says, it is what it is, and you've got to play the team in front of you on the schedule, right? So we can't control what the Fed's going to do. We can't control what interest rates are going to do. But what we can do is game plan and come up with specific strategies to address these high interest rates and affordability issues that are going on right now in the housing market. And anybody who's been following me and talks with me knows I'm a big fan of implementing the seller buy down strategies, whether it be a permanent buy down, a 2-1 buy down, or even a 3-1 buy down. These are great strategies to use to address affordability. And history has shown us that after a recession, mortgage rates always come down. So hang in there, this too shall pass. And, believe it or not, this is actually not a bad time to buy a house. Cash offers are way down. Sellers are more open to negotiation and concessions. And quite frankly, there's just less competition out there, right? So people always ask me, Mike, should I buy a house or should I wait it out? And my answer is always the same. If it's the right move for you and your family and it makes good financial sense, buy it. Homes are expected to still appreciate 4% over the next calendar year. So the sooner you get into the house, the sooner you'll start building equity, as opposed to waiting it out and not building any equity at all. And what I've been telling people is marry the house if you like it, but date your rate. Okay, when rates come back down, as history has shown us time and time again, We'll kick your old rate to the curb, get you a nice brand new shiny rate, and hopefully that will be for your forever mortgage. Now, on the flip side, if it's not the right financial decision for you and your family, don't try to jam a square peg into a round hole, right? Don't try to think that you can time the market or float rates or any of that nonsense, because quite frankly, it doesn't work. So the bottom line is, it's going to be a rough go for a while. I mean, this is just another economic cycle that we have to go through. And as I said before, it won't last forever. But what is important is that you remain calm and have a solid advisor like myself, who has not only one, but several different strategies on how to deal with market changes and affordability issues. In this market, education, knowledge, and advice is far more valuable than the number with a percentage sign behind it. Okay, so if the time is right, we'll know ahead of time what the plan is and how to execute on it. And if it's not the right time, I'll work with you to get you to that place, so that when you are ready, or if an opportunity does present itself, we're locked, loaded, and ready to roll. So the worst plan is, quite frankly, to have no plan at all, right? So Mike Malarczyk, New Fed Mortgage, please call me, text me, email me, whatever. Advice is always free, and I would love to help you out. So hang in there, everyone. Take care of yourselves and your family, and we'll get through this.